pledge will be led by the gentlewoman from Texas, Ms. Johnson.
I'm here this morning just to address education. How do we know? Because the people have told us so. We represent the real. The ideal way to alleviate the shortages is by ensuring that children of all races and both genders receive the basic grounding in science and mathematics that will prepare them to pursue careers as scientists, engineers, and technologists. Is it not time, then, for America to grow morally? For those who fear to answer this question, I will answer it for them. The time is now.
Now more than ever, what happens in Washington impacts us here in the Dallas-Fort Worth area. Your Congresswoman, Bernice Johnson, will help you understand what goes on inside the federal government and share perspectives from today's leading policymakers and opinion leaders. And now, your Congresswoman, Bernice Johnson.
Welcome to the Capitol Report. Today we have a very, very interesting session. And I want to welcome Josh Silver, the Vice President of Research and Policy at the National Community Reinvestment Coalition. Mr. Silver is a graduate of Columbia University and the Lyndon Baines Johnson School of Public Affairs at the University of Texas, Austin, Texas. He's been with the NCRC since 1995, and prior to that he worked at UAW and the Urban Institute. Today we will discuss ways we can expand access to credit and capital for traditionally underserved communities. We will also talk about the Community Reinvestment Act, a law that has been in the news a great deal recently. And so I'm going to welcome Mr. Silver, and I'm going to thank you for being here, and I want you to start to talk about what we need to change to make things better.
Sure, and thank you so much, Congresswoman. It is an honor and a privilege to be on your show today. Well, first of all, a little bit about the National Community Reinvestment Coalition. We're an organization of 600 community organizations around the country, including many in Texas and the Dallas area. And our community organizations work to increase access to credit and capital for working class and minority communities because we believe that is the way that communities can grow economically through increases in small business ownership and owning a home and credit and loans for affordable rental housing and economic developments. And in fact, the law that we're going to talk about today, the Community Reinvestment Act, has been very beneficial for minority and working class communities in providing access to responsible credit and capital. So I want to thank you.
Well, thank you for being here. Historically, people have had difficulties getting credit. And right now, it is very, very difficult. Let's discuss that Community Reinvestment Act. Any time for reauthorization or reform?
Absolutely. And the Community Reinvestment Act was enacted by Congress in 1977 because, as you mentioned, people did have trouble getting access to credit. And in fact, there was discrimination against entire neighborhoods. Banks used to literally draw red lines around neighborhoods. And that was the genesis of the term redlining, where banks would draw red lines around neighborhoods and refuse to lend in those neighborhoods, even though they had bank branches in those neighborhoods. And Congress realized that this was a quick way for neighborhoods to decay and decline when people couldn't get home loans, people couldn't get small business loans. So in 1977, Congress passed the CRA to make that discrimination illegal and to go one step further, to say that banks actually have a requirement, an affirmative obligation to make loans and provide bank services in low and moderate income communities. The way this act works is federal agencies actually examine banks and give them a grade, like a report card. And they get a grade. There's one of 4 grades. So they get a grade. And then if they get a low grade, when a bank wants to merge or acquire another institution, the low grade can either slow down their merger, because federal regulatory agencies have to review a bank's merger application. It's usually the Federal Reserve Board. and the agencies can either approve or deny the merger application. When there is a problem with the CRA performance, let's say a bank's not making loans to low and moderate income people, generally what happens is the merger approval process is delayed, and occasionally the bank has to make promises to increase lending to low and moderate income people. So it's through the exams, through the merger application process, and through the data that's publicly available. Anybody from the general public can see what any bank in the country, how many home loans, how many small business loans a bank is making to low and moderate income people, or how many home loans are going to African Americans or Hispanics or women. This is very powerful. It's like a public report card. And all these public accountability mechanisms has resulted in very healthy increases in loans to minorities, to women, low and moderate income people. Just to give you a couple of statistics in Dallas, I have a couple of statistics for you. Last year in 2007, we're not talking about the high-cost loans that have gotten this country in so much trouble. We're talking about the prime loans, loans at the going rate, loans that say are at around, right now it's low, loans at around 6% or even lower. Last year in 2007 in Dallas, there was almost 13,000 loans to low and moderate income people. $1 billion. And this is not, again, it's not the high-cost loans. This is the loans at the going rate. And it is clear that because of CRA, there wouldn't be 13,000 loans in 2007 if there was not CRA. There would be some, but it wouldn't be 13,000 loans. Small business loans, 192,000 small business loans offered by banks to residents in the Dallas-Fort Worth area. These are phenomenal accomplishments.
Back in 1976, I was in the Texas House, and I tried very hard to get anti-redlining legislation. And I had a real struggle because the institutions were really fighting against it. So we finally agreed to attempt to get some hearing committees that would listen to someone who'd had a complaint. Well, that really did nothing. But I believe that these banks can say they've made money by implementing this act. Has there been any research to show that they have not lost a lot of money in making loans to low and moderate income people?
Well, that is an excellent question, and in fact, yes, there have been some studies that were completed. Back in the year 2000, Congress actually asked the Federal Reserve Board to look at the safety and soundness of loans made under CRA and the profitability of those loans. And it's very important to say to the audience that CRA requires that credit needs to be met consistent with safety and soundness. And whoever put that into the 1977 law was very, very wise. Because, in fact, we can talk about it in a little more detail, but we have studies that have shown that banks covered by CRA have made safer and sounder loans than financial institutions not covered by the law. And there's a whole segment of financial institutions not covered by the law called mortgage companies. And the Federal Reserve has shown that mortgage companies are much more likely to make the high-cost loans and other loans with very risky features. Let me give you one startling...
That's what saturated our community.
Absolutely. Let me give you one startling statistic about this. In the year 2007, there was the companies that report data to the federal government. There was 169 of these companies that failed in the year 2007. 167 of them were mortgage companies not covered by CRA. So what we see is the lenders that are still standing are the lenders that are covered by CRA because CRA requires safe and sound provision of the credit. And just one other thing is in the year 2000, I mentioned Congress asked the Federal Reserve Board to study CRA, and the Federal Reserve Board did a survey of the banks across the country. And the results were that CRA loans made to low and moderate income people, the great majority of banks said these loans were as profitable or more profitable than the other loans that they made.
Well, at the time that I started trying to work with this, there were neighborhoods who needed some home improvement loans. but the banks had a ruling that they had to be $25,000 and up. Most of those homes weren't selling for $25,000. They needed $3,000 to $5,000 loans. As a consequence, and I've met, back at that time I was meeting with a lot of bankers, and I said, you are going to be responsible for allowing these neighborhoods to go down because the people cannot keep them up without some small loans. We finally did get a credit union who was more responsive for, during that period. But there was a real need for that legislation. We started seeing branches of banks just pop up everywhere. And I said, we just don't want to see the buildings. We'd like to see some real service and action. So I really believe that it has helped greatly. But I'm very concerned that most of these foreclosures did not have, these mortgage companies did not have this protection. And that's where the foreclosures came, because they had all kind of creative subprime loans. They made loans to people that really couldn't afford them, but they had no idea that they could not afford them. The small print was something that many of them did not read or understand. But when you have this coverage, it requires the review of the person who is attempting to make that loan very, very carefully. And so many people don't get into those subprime loans or loans they can't handle that blossoms or whatever in 3 or 4 years. You don't see that on a home from a bank, but you see that a lot for in the mortgage company. So that's the reason why I think it's important when this legislation is reauthorized to include all institutions that make loans for home improvement or mortgages, the whole body of it, because it'll be safer for the banks and definitely safer for the borrower.
Well, first of all, Congressman, we want to thank you. The National Community Reinvestment Coalition, now 600 member organizations, want to thank you from the bottom of our hearts for being the CRA champion on Congress with your co-sponsor, Representative Luis Gutierrez of Illinois, because your CRA Modernization Act of 2007, in fact, would apply CRA to a lot of non-bank financial institutions, including mortgage companies. And we look forward to working with you to reintroduce the act soon. And what you, in your very eloquent statement, you mentioned some very important points. Bank institutions not making loans of $25,000 or less. And NCRC has a civil rights enforcement program, which we call National Neighbors. And just a couple of years ago, we found that redlining was alive and well. Our staff identified 35 institutions that still have policies like this. No loans. Nowadays, it's like no loans under $75,000 or no loans under $100,000. And they still have these policies. But we found that 26 of the 35 institutions that had these policies were mortgage companies not covered by CRA. That banks, because they have an examination that gives them a grade on how well they're serving communities, most banks won't dare to have these policies. That these policies are still, in most cases, done by the mortgage companies, not covered by CRA. Now, there were a couple of institutions that were banks that had these policies, but interestingly enough, in most of these cases, these were the affiliates of banks. Banks can have mortgage company affiliates. And guess what? The mortgage company affiliates are not automatically included on the CRA exam. It's at the option of the bank. And in fact, in these cases for the affiliates, we found that they were not on the CRA exam. So one thing that your bill would do is we say all parts of the bank have to be on the CRA exam. Now, the other piece to this is, even though CRA has been tremendously beneficial for communities, we know that there's too many working class and minority communities not getting enough access to responsible lending that they deserve. And when there's a vacuum, when there's too few lenders in the community, that's when the abusive lenders jump in. And we saw particularly in the late 1990s, and it really accelerated from about 2003 to 2007, probably the worst abusive lending during those years, all those exotic mortgage products. And again, we saw that those mortgage products were done by institutions that were lightly regulated. Mortgage companies do not have examinations done by federal agencies because they're not banks. And you know what's also very important as well as updating CRA is to do a regulatory rehaul, an overhaul, and to make sure that all these institutions that are lending, whether they're brokers or mortgage companies as well as banks, have regular examinations, CRA and safety and soundness exams. And in fact, the Federal Reserve Board has found recently that only 6% of the high-cost loans were on CRA exams, or loans made to low, moderate-income people considered on CRA exams. So 94% of the high-cost loans were loans not considered by CRA exams because the great majority of these loans, again, were made by independent mortgage companies. So it really shows the importance of accountability, and nothing like transparency, a report card, data. That's so important. And also, anybody from Dallas or anybody from the community can make a comment to a CRA examiner and have that comment considered seriously. So it's also the democracy with a small d that has been one reason why this law has been very effective.
You know, and honestly, this is as helpful to the financial institutions as it is to the persons who make the loans, because it has some responsibility for both sides. There is a real reason why the mortgage companies kind of went wild, but they also, many of them went out of business because they didn't get this money repaid. And without that protection, there would be nothing to protect them as well as the buyer or the person who's made the loan. So are there questions about whether or not these mortgage companies should be brought under this protection?
Well, the mortgage companies probably aren't too excited about being covered by CRA. But what's interesting is I think that you have seen a lot of banks say that CRA is not banks themselves have said CRA is not responsible for this mess. CRA has actually helped us realize profitable lending opportunities. Has helped us realize, hey, there's really some markets out here that we haven't been serving. So I think that the banks that are regulated by the federal agencies really want to see their counterparts, the mortgage companies, and let's even talk about large mainstream credit unions too. Their counterparts covered by CRA, because CRA does two very important things. It requires all lenders to make loans to meet credit needs in the communities, but also meet credit needs consistent with safety and soundness. So to have the bank needs the mortgage company and the broker covered by these laws, because one thing that happened in 2003 to 2007 is, you had some mortgage companies and brokers making really irresponsible loans, and you had a race to the bottom. Not everybody, but there was a real pull. Some responsible lending institutions themselves started loosening up because they would lose business. So to prevent that dynamic, just cover everybody with strong consumer protections and CRA, and then you stop the race to the bottom to the riskiest lending practices.
Well, when we looked at where some of the foreclosures were coming, many of them were in places where the mortgage companies did the subprime loans and all these creative type loans that ballooned after 2 or 3 years, and the persons were not expecting it to balloon as much. And in situations like that, the borrower, if you have a safe and responsible loan, the borrower cannot get loans outside the amount that they can afford, putting their income and what other debts they have already. But with mortgage companies, I don't know whether they even check it that closely. And that's what has caused a lot of this crisis, this foreclosure crisis. And it has not really been the institutions that are covered by CRA. So that's that would be an improvement for the consumer as well as a financial institution.
Well, that's absolutely right. And we've been working on the predatory lending issue for at least a decade, more. But what we saw, and it's quite a story. And it was initially a very positive story, and then it became a very sad story. In the mid-1990s to the late 1990s, CRA was strengthened by the Clinton administration, and you saw a big increase in responsible lending to low and moderate income people. Not these crazy balloon loans, not these exotic mortgages, prime loans. And then, starting in the late 1990s, you saw the mortgage companies and the other lenders, hey, there's gold in those hills. There's profits to be made. And then they started...
And there was a lot of pushing for home ownership.
Right. And then, so that's when more of the unscrupulous practices, and, Wall Street had a big role in financing these unscrupulous practices.
And that brought Wall Street down.
Absolutely. We see in a very dramatic and in startling fashion. Absolutely. So starting around as early as 1998, year 2000, NCRC, our member organizations, were pleading and begging Congress and the federal regulators, pass a law, implement a regulation. It's actually very simple. Thou shalt not make a loan beyond a borrower's ability to repay. Simple concept. Do not make loans beyond a borrower's ability to repay. So,
and that's really pretty easy to determine.
That's right. You look at your income versus your housing payment, and you have a ratio, and you really shouldn't be paying more than a third of your income for your housing expense. And so the Federal Reserve Board, when did they toughen up their regulations against unfair and deceptive lending? Summer 2008. Even though we'd been asking them for 10 years.
Probably after the crash, or very near the crash.
After the crash. So, and they strengthened their regulation in significant ways, but they still left a lot of loopholes, a lot of ways for unscrupulous actors to get through the door. But still, it took them 10 years. And so what we need going forward with the new administration coming to town is to modernize CRA and to pass a comprehensive anti-predatory lending bill that covers all parts of the financial industry. Banks, mortgage companies, appraisers, Wall Street, investment banks. And if we had modernized CRA and said there is an obligation to make credit available consistent with safety and soundness, it's our position that we would not be in this financial calamity today.
Well, I agree, because when people are offered what looks like a big new Christmas tree, and they see everyone else getting one and loading it down, they want the same. And there were a number of mortgage companies that were used in new areas where they were building moderately priced homes. And if a person went in there to ask the question, they said you couldn't get out without buying a home. Well, about 3 years later is when all the crash came, and that was an entire area in my district that went bankrupt, that the foreclosures came. I should think that is not only consumer protection, it is also protection for the financial institution. So it would seem to me that the mortgage companies ought to be ready for some protection.
I think they're coming around. I think that there are broad segments of the financial industry that realize we need to level the playing field. We need to have uniform law and regulation for all of us, because otherwise you do see a race to the bottom where you have a lot of pressure. A lot of financial institutions are getting pressure to adopt that risky practice that the fellow down the street is doing. So in order to prevent that dynamic, you level the playing field and you pass uniform consumer protection law and regulation, and you modernize the Community Reinvestment Act.
Yes. Well, I hope we'll have success doing that. What do you see as the status of home ownership since we've had this crisis?
It's going to be, 2009 is going to present us with tremendous challenges. Let's hope in every crisis there is an opportunity. The first thing we have to do, first and foremost, is a massive foreclosure prevention plan. And by the way, banks under CRA get points on their exams for foreclosure prevention activities. That was just reconfirmed about a week ago by the federal regulatory agencies. So the first thing we need to do is use the TARP money, the Troubled Assets Relief Program.
We're trying our best.
I know you certainly are. And Chairman Frank of the House Financial Services Committee just had a hearing on Tuesday in which the President and CEO, John Taylor, testified at. And we've been asking for a massive foreclosure prevention plan that modifies say 3 to 5 million of these distressed loans. We have Credit Suisse estimating there could be up to 10 million foreclosures in the next 4 years. So we have to have a foreclosure plan that modifies millions of these loans. And then once you've done that, once you've stabilized neighborhoods, then you can resume the work of increasing home ownership. And we also have to provide a lot of affordable rental housing right now, especially in this crisis, to prevent a rapid increase of homelessness.
Because there has been an increase in homelessness since this has happened. And I believe that if the institutions really want to stay financially healthy, that they would welcome some of this protection. And I know that it seemed like the mortgage companies were making a lot of money back then, but the Wall Street that was keeping them pumped up went down. So when we did the Rescue Act, we thought we put some protection in there for foreclosure control. But it has not been carried out, so we're going to try it one more time and see if we can get there, because the people were expecting that not only Wall Street would get some assistance, but the consumer would also get some. And that hasn't happened yet, but we are hoping that soon that will be happening, because it has hurt Main Street as much as it's hurt Wall Street. As a matter of fact, probably even more, because the people who run in Wall Street left with quite a bit of money. They were making a lot of money. But the people in Main Street were making the same and losing everything that they were investing in this property. So it's time. Consumer protection hopefully is back for a while.
I think that this has changed the debate for a generation, and hopefully more. That if you treat consumers fairly, your whole economy will prosper. If you're unfair and deceptive, the whole economy will eventually come crashing down. Because the central problem in our economy is foreclosures. If we do not get a handle on foreclosures, our economy will not be able to recover. We have lost trillions of dollars in housing wealth because of unscrupulous lending.
We're out of time, but thank you so much for being here.
Well, thank you so much, and thank you so much for championing CRA. It's a pleasure to be on this show.
Thank you.
This has been another edition of Report from Washington featuring Congresswoman Eddie Bernice Johnson. You can reach Congresswoman Johnson at 202-225-8885 or 214-922-8885. You can also contact her through her website at http://www.house.gov/ebjohnson.